Hello, welcome. Nice to have you join me for week 7, chapter 6, internal control and accounting for cash. So the first half of the chapter talks about internal control techniques, and the last of the chapter on accounting for cash. So the introduction is on pages 312, 313, and they talk to you again about the curious accountant and the introduction to the topic and the chapter outline. And then on page 314 to 317 comes the key features of internal control. Now, internal control is the security environment that managers create to safeguard assets and to safeguard operations and to make sure that resources don't disappear from the business or that they aren't used inappropriately. So as you look at the chapter, you'll see that it says there are key features of internal control, and it tells you that the first step in management's work is to take an assessment of the controls and the risk that's present in the business. And so to do that, you look at a series of items. Now, these have been in place since 1992. They are protocol by de facto. They aren't required by anyone, but they've proven to be so useful that they've become common practice. So the first thing that you look at is the control environment. And the book says the integrity and ethical values in the company, how they are reflected in the practices and procedures. A code of conduct. Is the board of directors involved? Are there other actions that set the tone of the organization? Is it clear to everyone what the ethical framework of the company is? And are there procedures and practices in place that examine those, that review those on a regular basis? Secondly, they do a risk assessment. It's the management process of identifying potential risk that could result in misstated financial statements and developing actions to address those risks. So if they see, if management identifies in these actions some area that seems to be underprotected, then they would take actions to see that new procedures were put in place to control for those particular practices. So that leads us to control activities. Activities usually thought of as internal control, they include such things as segregation of duties, account reconciliation, information processing controls. So we'll have more in depth on certainly some of those activities in the coming pages. Management makes sure that those are in place. They see how rigorously they're enforced. Auditors help spot check those throughout the enterprise. Information and communications, the internal and external reporting process, and includes an assessment of the technology environment. So you see how safely guarded your technology is. You see how your firewalls are working. You see if there are how many breakthroughs or intrusions there have been in your technology. You also test the technology, again, spot testing the technology as an auditor to make sure that that those aspects tested cannot be penetrated and are processing correctly. Then monitoring, assessing the quality of a company's internal control over time and making actions as necessary to assure that these continues to address any risk. Now, what you will notice here as you think about this monitoring, management is doing that on an ongoing basis. They're doing it as part of the accounting audit. They're doing it as part of the ethics audit. So, and probably now they're doing it as part of the environmental audit. So as we think about the various ways that the company looks at its own operations, we see that we can include internal controls in all of those. Now, when the control activities that were in item number 3, then you turn to cross the page to 315, and you see separation of duties. And as you can read there, separation of duties are that you make sure that no one person handles every step in a process from the time the asset is acquired until it's disposed of. You have other people involved in the use and accounting and recording of that asset's activities, especially cash. You think about the quality of the employees. Are the employees well qualified? Do they have the background, the education, the experience, the capacity, not just the ability, but do they have the capacity? Do they have enough time to do all of these steps so that need to be done? Are they well versed? Is their training up to date? Are they current in their reviews of certain topics? And then, are the employees bonded? Do you have a fidelity bond that covers everybody who covers works with cash and with certain other valuable assets? And then that people are required to take a break in service. There's required absences. Now, those absences are generally called vacations, so you have a rotation of duties then that someone goes off of a task for a certain period of time. That can be the required absence. You can just rotate through the activities, so you change activities from time to time. Or you can also enforce vacations so that everybody has to take a vacation. And when somebody doesn't want to take a vacation, then you begin to really look at their work, and there's probably some reason that they don't want to take a vacation, and it's oftentimes because they're protecting a fraud. There's generally a procedures manual on how all the steps are to be done and what all the steps are. So that would be in place. There's authority and responsibility. So somebody has authority to act in a way, there's a responsibility to carry that out, and then there's accountability to see that the work has been done correctly. Perhaps it has a peer review process or something of that nature. And they use pre-numbered account documents. So pre-numbered sales slips, pre-numbered checks, pre-numbered cash receipts, those sorts of pre-numbered purchase orders, so that people, they're assigned that way. In today's technology, the pre-ordered is that somebody pulls up a purchase order, and whatever that number would be for the next one, the computer gives it that number, and then that number's in place for pre-numbered documents. There's a physical control of the assets. So if you look around some of your classrooms, you'll notice that our equipment here at Humboldt has an HSU sticker on it. I assure you that in the summertime, someone comes around with a clipboard and checks all of the items that are supposed to be in each classroom, the items that are supposed to be available. Perhaps actually from your vantage point in the sitting out in the class and looking at the back of the equipment, you might see those yellow tabs even easier than those of us who are working from the front can see them, because they're generally on the back or some obscure spot on the asset. You'll also see that many of them now are bar-coded, so all they have to do is put a wand out there and they'll know exactly which item is present at each location. There's performance evaluations that are done on employees, and performance evaluations that are done on autonomous technology where no human beings interacting with it, so that you can see, is the person up to date? Are they doing the work correctly? How, when they're doing the performance evaluation, you ask them about questions like, what was your most egregious equity question that you saw, or your most egregious ethical question that you saw, or your most egregious internal control question that you saw. You can ask that same question several ways, but you want to know what they have identified throughout the year. If they're not identifying any internal control issues and they're not identifying any ethical issues, then you can begin to think maybe they need training in order to know what those are, or perhaps they're withholding information. So that's a performance evaluation. It also helps you know if your employees' qualifications are where they should be. And then limitations. So people identify what are the limitations of this internal control system. What is it not doing? How should it be expanded? Where should we improve the internal control? So as you look at those characteristics and components of an internal control system, you begin to get an idea of what management is doing to assure the safety and the integrity of the assets of the business. One of those most important assets is cash, and so on page 317 we begin a study of cash. It goes from 317 to 321. So when we're thinking about cash, we're talking about cash on hand, so any money that's in the business, such as a petty cash fund or a cash change fund, money in banks, so you're looking at the various bank accounts, money that's on deposit someplace as still cash, but on deposit as a certificate of deposit, or a savings account, or a working money market account, something like that. So we begin to think about accounting for cash. We're going to be talking about just the cash account itself. So we're going to be talking about those checking accounts. They talk about controlling cash, and here we get into making sure that you're using cash receipts, that they're pre-numbered, that one person takes in all the cash but doesn't necessarily bank all the cash, that would be separation of duties, where one person's taking in the cash, processing it, but somebody else is actually making sure it's deposited in the bank. That there are cash payments. Again, the checks are pre-numbered. The checks in every account are accounted for. Every one of those accounts is reconciled at the end of the month. So then when we have a checking account document, each of these checking accounts that I've been talking about, the book says, you know, there's a signature card so that you know who's allowed signature. In today's world, many times the signature is affixed by the computer, but it's who has authority to authorize that run of those checks that becomes important, because basically that person is the person that has the authority and responsibility for those cash payments. There are deposit tickets, and then deposit tickets are made out every time you have to make a deposit. And of course then there's the bank statement itself, and at the top of page 321 they give you a picture of what a bank statement looks like. You probably have some sort of a banking arrangement yourself, so you might get a statement every month that looks just like that. And then so those are the components that make up the bank account. And whether it's a business account or a personal account, they all have those same elements. Now, a business account has many more activities than a personal account, probably every day, but every month certainly. And so there are a wider variety of account transactions. At the end of the month, the bank should be reconciled, and so bank reconciliation starts on page 321. Bank reconciliation starts with receiving this bank statement from the bank and then having the general ledger cash account in the business. So they're going to talk to you about how these are determined. Now, bank reconcilements can be done actually 4 ways, and any of them are acceptable, but there are some that are more common. And the common ones are becoming even more common because as we're programming computers to do these bank reconciliations for us, they're all starting to look even more alike. So when they talk when they talk to you about a common bank reconciliation, that's what they're talking about. So when we get to the top of page 322, they talk about the adjustments that you would make for the bank. And the first one they talk about is deposits in transit. So at this point, we're looking at adjustments to the bank deposit and to the book deposit. Now at the bottom of page 321 where it says determining the true cash balance, how much is really there, they're talking about taking the bank statement and taking the general ledger cash account and making the adjustments to each one of those that need to be made and get an agreed upon balance between the two of them. And that's the true cash account. And that's the cash account that with the journal entries at the end of the bank reconciliation, that will be the actual general ledger cash account balance. So that's what we're working towards. So it begins with, as we turn the page, the bank balance, we take the unadjusted bank balance as it appears on the bank statement, and we add the deposits in transit. So any deposits that we'd made in our general ledger account that are not yet on the bank statement, we have to add those to the bank's balance. So we have to add deposits in transit because they were in transit, but the bank didn't have them yet by the time the statement was printed, but they are in our general ledger cash account. So we have to give the bank account, the bank's unadjusted balance credit for those deposits in transit. The outstanding checks are checks that we've written and recorded in the general ledger cash account, but they're not showing on the bank statement. So they're still outstanding at the time of the printing of this bank statement. They've not been presented to the bank for payment. And so we have to make a list of those by number and amount and a total, and we have to subtract those totals from the bank balance because we've already written checks for that amount of money, and that needs to be subtracted from the bank. Account receivable collections, so any collections that the bank does for us, and there will be notices in the bank statement about collections that they do on our behalf. Some of those collections might be automatic every month, and with electronic transfers, we're seeing more and more of those automatic receivable collections. And then interest earned, sometimes the bank collects interest for us on our investments, and so the interest is paid monthly directly to the bank, and so then we have to add that into our general ledger cash account because we haven't recognized it yet. We didn't know it was collected till the bank statement came. And then service charges, which the bank will charge us certain fees, and we have to remove those, subtract those from the bank balance as well because the bank already subtracted them for us. The NSF, or non-sufficient funds check, we always assume that the non-sufficient funds checks were given to us by a customer and their check did not clear. Our checks would be always set up to clear. So even if we had a line of credit that we needed, all of our checks would pay. Our checks would not be the insufficient fund checks. The NSF insufficient fund checks would be from our customers. So when we look at those, we have to reestablish that as a receivable and subtract that from our general ledger cash account because we did not get that money. So as we think about that adjustment when we're doing the bank balance, we're looking at those insufficient funds and correcting them. And the next one is correction of errors, and errors do happen. People transpose numbers, people put the decimal point in the wrong place, all kinds of things happen. And so we do have to correct all the errors that are discovered through the bank reconciliation. And certified checks are checks that we had the bank issue on our behalf and they didn't go through our list of checks. So the bank issued that certified check out and for us. And so those certified bank checks that we had sent to someone have to be entered into the bank reconciliation. So they give us then an illustration of a bank reconcilement that starts on page 323. And the sample problem the introductory problem for this chapter is also a bank reconciliation. And in the comprehensive problem, the bank reconciliation is there, but you don't actually have to do it. You'll just review it. So when we look at illustration of a bank reconcilement, notice that it says gives you a list of adjustments to the bank balance. So you should look at those adjustments and decide how they would be entered, what each of them would be. But if you turn the page and you look at the Green Shades Resort in Exhibit 6.3, you can begin to see that it's got the unadjusted bank balance at the top. It's got add deposits in transit next, and then it's got less the outstanding checks, and then it gives you the true cash balance from the bank side, and then you look at the unadjusted book balance just below that, and that's from the general ledger cash account. So you put that amount in there, and then you add and subtract depending upon what you need. So in this particular example, they added receivable collected by a bank and an error by the accountant. They took out the service charge, they subtracted out the service charge and an NSF check from a customer, and then the true cash balance has to equal on both of those. And that's what makes it the true cash balance. So as we go through here and we look at this information, we can begin to see how these are adjusted. Now, we have to write some journal entries. So the next major part of this is adjustments to the book balance. Now remember, we can only write journal entries in our own books. We can't write journal entries in the bank's books. So all these journal entries have to be in our own general ledger account. And because of that, they can only come from the adjusted book balance. And another way of looking at it is all the information in the adjusted book balance has to be recorded in the general ledger. So you just go to the adjustments to the book balance and you start writing those journal entries because you want that information recorded in your general ledger cash account. So at the bottom of page 324, they have each of these transactions, a receivable collected by the bank, and so adjustment 1 is a receivable collected by the bank. And then the next one is an error made, and number 2, there is an error made. And you can see the journal entries that they write. You can see the effect that those journal entries have on the accounting equation and on the financial statements. An NSF check, and adjustment 3 is a service charge, adjustment 4 is an NSF check. And then there was a mistake, and so you have a final transaction for cash over and short because you made someone working in the company made a mistake and there was a $1 error, and so in this case they're charging the expense cash over and short for the money. You could be crediting it and making that expense go down as well, depending upon which way the error went. But you would always use cash over and short. A new expense account with this chapter, and again a temporary account closed at year end, has a debit balance because it's an expense. So cash over and short is a new expense for you. That brings us to the end of the bank information on the general ledger cash account. And so then the chapter goes on to talk about using petty cash. And petty cash is money that you have on hand in the business. Generally, somebody has a little change box and they have $150 in there or $500 in there, some amount. And when people need something quickly, they can come there, get money, go out, buy what they need, and bring back the receipt for what they bought and the change. And then they give the holder of the petty cash the receipt and the change. So between the sum of the receipts and the sum of the money, the petty cash will always equal whatever its total is, $100, $500, $150, whatever the amount is, that's the total. The receipts plus the cash on hand will always equal that total. And so then you make out documents a petty cash voucher, you number those, you make sure that you are accounting for all of the money that was spent, and then so on the top of, in the middle of page 327, you have the journal entry to set up a petty cash. This one has $300 and it's a debit to petty cash and a credit to the general ledger cash account, and you would actually write a check, go cash that check from greenback dollars, and then you bring that money back in and bring it into the business. And then after that, you would make out these vouchers for miscellaneous expense, a payment from the petty cash, and then you replenish the petty cash. You don't replenish the petty cash until it's pretty well depleted. They had this one down to $216 that they had spent. So they would only have $84 in the drawer, so they probably needed to go and get that other $216 replenished, write another check to debit the expenses and credit the cash, but not the petty cash. Debit the expenses and credit the cash, and then cash that check, bring the cash back, and the cycle starts over again. So you can see the journal entry in the middle of page 328, and the analysis of what happens to the accounting equation. And at the very bottom, you see a large, complex journal entry. It's compound. It's got 4 debits, I think, and then the 1 credit to cash. And so it shows you all the transactions that they had. And there was a 70-cent mistake at the top of the next page. So again, they're demonstrating cash over and short, a new expense account for you, this chapter. Now that is all the discussion of cash that the chapter has. It's just internal control, the cash account, the general ledger cash account, which is a checking account, and then the reconciliation of that checking account and the maintenance of a petty cash account. But when we get to page 329, what we have here now is that financial analyst. And in this particular passage on the financial analyst, they tell you that there are the 4 parts to an annual report. And now the first part is the financial statements, those 4 financial statements you know. Income statement, owner's equity statement, balance sheet, and statement of cash flows. And then they're adding to you this time the notes to the financial statement. The notes are very extensive. They're very informative. They're in great detail. They're generally written by a crackerjack team of attorneys and accountants who sit down and try to faithfully depict exactly the transactions that are occurring and are represented by those numbers. And then management's discussion and analysis of the financial statements, and then the auditor's report. So those are the 4 parts that are there. The statements, the notes, management's discussion, and the auditor's report. And so at the bottom of page 329, they talk to you about the notes to the financial statement. And we actually have some back here in our textbook. If you look at Appendix B, and I'll tell you that page number in just a minute, the financial statements start on page 722, and then the notes back here on 727. So you can look at those financial statements. The notes go from 727 to 753. So almost 30 pages of pretty small print, single-spaced, what those notes look like. So you can look back there and see those notes starting on page 722. There's a discussion of management's, there's a presentation on management's discussion, I should say, and management's discussion is how they analyze the number. They're trying to tell those outside decision makers, those outside users of these financial statements, their perspective on it, their pitch on what they want analysts looking at. And then there's the role of the independent auditor. every publicly traded company in the United States has to have a CPA, a certified public accountant, audit their books every year and attest that the audit results show compliance with generally accepted accounting principles and practices, what we call GAAP, GAAP, generally accepted accounting principles and practices. So as we look at that, that's what the auditors are doing every year, and only a CPA can attest in the United States to the soundness of the financial statements and the operations that they represent, the business operations that those financial statements represent. So they talk about a financial statement audit and tell you pretty much what I just told you. They say that they want to make sure that there's no material difference between what the auditors observed and what the financial statements would say, and if there was a material difference, they would have to work together to resolve that difference, management and the accountants. And materiality is a relative concept, but the basic rule of the thumb is that if the auditors feel that the information would significantly influence a decision maker's outcome, would a decision maker significantly change their decision, then the information should be disclosed. Then it becomes material. So if it would influence a decision maker one way or the other, whichever, it doesn't matter if it's positive or negative, but especially though if it's negative, then the information should be disclosed. And then they give the types of opinions that are here, and of course an unqualified opinion where everything is fine is what people want. There's an adverse opinion, there's a qualified opinion, and then there's a disclaimer. And very rarely does a set of financial statements, are there not improvements to get a set of financial statements away from a disclaimer and a qualified opinion. So then we talk about confidentiality. The book talks about confidentiality, and the accounting profession talks about confidentiality. Accountants do not have the protection in law, in the court, that a doctor or an attorney has. So we don't have that privilege, but we do have confidentiality and privilege outside of the courtroom. So other than that, we shouldn't be disclosing anything that we know. Accountant, the CPA who does this audit, should not be disclosing anything she or he knows about this business, even to the point of maybe not saying that they're even a client. So many times the fact that you're the client becomes public because of the audits, but that you have this confidentiality with your client that you just, excuse me, that you just do not disclose. And it's probably hard for you to imagine, but I think sometimes coming out of public accounting, you just learn to forget whatever you saw. I mean, at the time you saw it, you worked it through, but you just don't really recall it. And I tell you, I feel the same way about grades. I don't recall later what grade you got. I'll see you in Costco or Safeway or someplace, and I'll just be thinking, that person was in one of my classes. Maybe it was the accounting class, but I don't think about the grade that you got. I've trained myself to forget that. That's done. That's nothing I can disclose to anyone anyway. And so I just forget about it. And that's that same idea of confidentiality. You have my confidentiality that I'll not tell anyone what your grade was, and you have your accountant's confidentiality that they will not disclose anything about your business to someone outside the firm. And even times to someone within the firm who does not have the privilege to know that information. They close with a passage on the Securities and Exchange Commission, and in the United States at this time, now that's going to change in 2014 when we become following the international rules, and we're not all just sure how that's going to change yet, but it's right around the corner. Up until now, from the founding of the Securities and Exchange Commission, after the crash of 1929, the Securities and Exchange Commission was charged with regulating public securities markets in the United States. And part of that charge was that they would have all companies that sold risk instruments, stocks, bonds, audited once a year by CPAs. And so they have allowed the Securities and Exchange Commission has allowed the CPAs to set the rules. So CPAs have, through the years, set the accounting regulations, and then the Securities and Exchange Commission has agreed to follow those rules. Now, when we had some major frauds, Congress gives that privilege actually to the Securities and Exchange Commission. And so Congress passed a new law called the Sarbanes-Oxley law, and they passed the law, and then the Securities and Exchange Commission had to enforce the law, and so of course then the CPAs have to enforce the law. So Sarbanes-Oxley changed that the CEO and the CFO, the Chief Executive Officer and the Chief Financial Officer, would attest against their personal resources and their personal integrity that these financial statements fairly represented, to the best of their knowledge, all the activities, and they could be culpable in court if there were major differences. So the Sarbanes-Oxley law was Congress's way of making the CEO and the CFO personally liable and therefore more engaged in the audit. And so that's the last topic in this chapter. There's a look back that gives you a nice highlight, kind of like this chapter where they're just numbered, 1, 2, 3. We've had some chapters where they were, all these ideas were just embedded in paragraphs. So here it makes it very easy to see and see what they look like. The self-study review problem is on page 335, gives you a nice presentation, and I will also prepare a presentation for you on the introductory problem in this chapter, which is, as I said before, another bank reconcilement. I hope this overview of the chapter has helped you. I hope it has been a guide to your reading. You might even start this and then listen to my comments and then read it, and then go on, listen to my comments, and then read that part of the chapter, just so that you're going back and forth and being an active reader, perhaps underlining, highlighting right at the time that you read what you see as the key lessons. Well, with that said, I thank you for listening to this YouTube video, and one of my other classes told me that I should start calling them a clip, because that's the new term for these videos. It's a video clip. And so thank you for listening thus far, and I'll see you at our next discussion.